You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's session, to spread or not to spread. I'm pleased to welcome our moderator today, Joe Burgoyne, who is an integral instructor for OIC. Joe is the Director of Retail Education for the Options Industry Council and is responsible for the Institutional, Retail, and University Outreach Education Program. He has over 30 years of experience within the finance industry and has managed the floor operations at the Philadelphia Stock Exchange for Von der Meulen Options USA and TAG Securities. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, to spread or not to spread. Joe?
Alex, thanks a lot. Yeah, that is today's question for sure. To spread or not to spread, I definitely want to thank everybody for joining us on what I think in many places of the country today is a beautiful, beautiful weather day. So thanks for joining us. I've got a good friend and fellow educator joining us today, Dan Sherton of Sherton Mentoring. Dan, you want to say hello?
Hello, everybody. Glad to be here. A beautiful day in Chicago, where I'm speaking from, and good to be here.
Well, thank you, Dan. And Andrew Giovanozzi is going to join us from Options Pit. Andrew, are you on yet? I know you're trying to get in. Okay, well, Andrew, I am sure will join us momentarily. But before we get started, actually, with the content part, as Alex said, the OIC, we are the educational arm of the listed options industry. I'm pleased to say Alex is a big part of our team, and we have been at this now for 25 years. The Industry Council is all about educating investors, financial advisors, and even those in the institutional space about the benefits and risks of the listed options product. So I'm sure that's why you're on today. As I said, the OIC's been around for 25 years, and we hope we have 25 or 50 more ahead of us for sure. I think one of the things that sets us apart is the OCC. And many of you may not be aware, it is the OCC that is responsible for each trade, buy and sell ticket that is matched on the 15 various exchanges. So, OCC is a big part of what makes the listed options market work. We have 5 parent exchanges. You can see on the slide, we've got CBOE, NASDAQ, BOX, MIAX, and the New York. And between them, there are a total of 15 different exchanges, 5 parent companies. And this is a slide, for those of you who have heard me present before, this is one of my all-time favorite slides. It speaks to the industry growth. We started in '73 in Chicago. 16 companies traded then. And many of you may not realize for the first 4 years, we only had calls. We didn't have puts until the SEC approved them in 1977. So, we started with virtually nothing. You can see we went basically 25, 26 years before we got to 500 million contracts trading annually. You see on the chart in the late 90s, a couple things happened. We got dual listing, which meant that rather than just trade IBM options in Chicago, you could trade them on all of the 5 exchanges at the time. That was important, the narrowing of bid-offer spreads. And then I think the thing that really jettisoned volume was the formation of the ISE, which was the first electronic exchange. So you can see after, and also we had the technology bubble back then. So, the platforms started to get more interactive, and you can see option volume over the next 10 years just absolutely exploded from 500 million contracts a year to north of 4 billion, where despite low historic volatility, the options market has been for the last half dozen or so years. Those 4 billion plus contracts come out to between 16 and 17 million contracts a day on average. And this year with increased volatility, we're actually averaging just north of 20 million contracts traded a day. So that's a little bit of history with the options market. And so actually before we get into the topics, Dan, how about if you, and Dan Sharton said a good friend, founder of Sharton Mentoring. Dan, why don't you tell us about your career in the business and what you do now?
Yeah, well, thank you, Joe. Appreciate it. It's exciting to see the growth of options over those years. I enjoyed watching that chart with you. It was pretty amazing. But I started in 1982, and most of the time I was down there, I worked with John and Pete Nigerian, 2 of the regulars. I think today, I think they still are on Fast Money on CNBC. The 2 guys that have a lot of hair on their head, those are the guys I worked with. I had the pleasure of working with for many years, and we were a specialist operation on the CBOE, trading in many different stocks, and that's where I learned the craft of option trading. And then in the early 2000s, I think 2003 or 2004, opened up Sheridan Mentoring to teach retail traders how to bring in income on a monthly or weekly basis. And I've enjoyed working with retail traders over the last 15 years or so.
And I mean, that is a passion, Dan. When you spend all day, educating fellow investors, you got a lot of gas in the tank because it's a great calling. So thanks for doing it. Why don't we get started?
Glad to do.
Maybe Andrew will jump on. Andrew, if you jump on,
can you hear me?
Hey, is that Andrew of Options Pit?
Yeah.
Hello, Andrew.
Andrew, okay. The technology master.
Let's pick it up, Andrew. We just went through a little bit of background. Dan introduced himself. Please let our audience know your timing is perfect. Let our audience know, about your history in the business, what you're doing now, and then we'll get going.
You mean Dan Sheridan?
The one and only.
Hello, Andrew. Good morning.
the guy that spent many a moon in a pit with me when we were both younger and skinnier.
And I'm here to talk about it. Yes, but much skinnier.
Yeah. Much skinnier. Well, I guess the short answer is I've been trading options first as a market maker for 16 years, and then as a teacher of option trading once the kind of the trading floors went all electronic. So I've been in the business since 1989. I'm CEO of Option Pit right now. We spend most of our time teaching people how to trade options. We also run 2 funds that we started a year or 2 ago. So and Carmen Line Capital, so we have a little subsidiary. I also know, Joe, when I was doing product development, I spent a couple of years, actually 3 or 4, trying to bring, let's just call it, new technology to the option place. So I've been there as a market maker, now as like retail educator. I had my own trading firm for 6 years. So I've kind of touched, I think, every part of the option world, and I'm trying to remember how many option contracts I traded, but maybe 6 or 7 million, I think, over the years. A lot.
And we appreciate you joining, and thanks to the wonders of technology. Andrew, I'm pretty sure you're up in your home base in Maine. Dan is in Chicago. Alex is in Chicago, and I'm outside of Philadelphia. So how about if we get going, guys, with the, we want to talk a little bit about, option pricings. We'll get into the, the debit and credit spreads, talk some, individual spreads as well. Before we do that, I would like to just get a gauge of our listeners. If you wouldn't mind, real quick, 2 questions. Do you use listed options? Yes or no? If you wouldn't mind submitting that. How are we doing on that? Okay, so, we got north of 80% are in the option space. One more question. Do you spread? That's the next one. And if you wouldn't mind answering that, we appreciate it, just so we have a sense for, who we're talking to, and maybe we can cater the discussion to you a little bit better. Ho, how about that, boys? 50-50. So with that, why don't let's start. The question of the presentation is to spread or not to spread. Andrew, I'm going to come to you first. Do you like just trading calls and puts straight out, or do you like to spread? What's your approach?
Oh, wow. That's a loaded question. I like to do both. Most of my trading is volatility dependent. So when vol's this cheap as of right now, I tend to just buy calls or puts if I'm going to buy something. And when I want to dampen a little of the volatility in the market, then I go spread via fly or something like that, or regular old vertical spread. So for me, it's a vol dependent trade.
Okay, I'll come back to that. How about you, Dan?
Yeah, I would say about 99% of the time I'm using spreads for mostly trying to generate income. And I think, I look at volatilities, look at price levels of the market, the speed, but when we're maybe lower volatility, which we are now, might look at more trades that would benefit from volatility going up, like calendars, that type of thing. And if volatilities get a little higher, look for more short vega choices, like credit spreads, butterflies, or iron condors. But I think overall, mostly spreads. I mean, not that it's in the speculative part of one's portfolio. You may use calls or puts, but that could be a costly game if you're not careful.
Well, indeed it can. So let's, we got a little bit of an outline in this conversation, but we want it to be free-flowing. So, Andrew, I'm going to come back to you. And, we got 81% of the folks online using options. So let's take this a step further in terms of that volatility conversation. Okay? Your spreads are vol dependent. I was just going to say, they're vol dependent. Run with that a little bit if you would.
Sure. So Dan made a good point. He's like, okay, well, option contract's like $18, right? That's an expensive contract. So when there is a time spread, or say a diagonal or a vertical spread, that's going to help me get the sort of the direction I want, but it's going to reduce the cost and still give me a good risk reward, then I'm that's when I like using a spread. When it could help save me some money if I actually want to be having, we'll call it a net long contract position, where the volatility difference between the two strikes helps me save money on a particular trade. It's like buying puts. I almost always buy put spreads or put butterflies just because puts are so darn expensive, and it's rare that the market just drops like 8%, right? So there's always like a smaller move really on the downside, unless the market's really falling apart, let's say. So you're not expecting a ton with that position. If I'm not expecting a ton, that's a position that wants a spread. Depending on where volatility is, right? If vol's very low, I tend to want more exposure to it. And when volatility is really high, I either want to be selling it or have less exposure to it. So I'm using kind of the relative level of vol, and that helps decide on what kind of spread I want, if I want one at all. In a stock that has, go ahead. Yep.
Well, and Dan, I will come back to you, but okay, Andrew, you're throwing a lot of terms around, and they're all good, and I get them, but some of our listeners may not. So let me back it up a little bit, and we will get back to maybe defining a butterfly and things like that. But we're talking vol, and we're talking relatively high, relatively low. How can a retail investor quantify that? How can they, walk us through that?
So what I do, or at least what I teach anyway, is I take any vol, let's say any index, equity, ETF product, anything like that, and I just break it up into quartiles. There's a lower 25%, a middle 25%, and then so on, right? So you have basically 4 quartiles for volatility. You can actually get a number for volatility, meaning what percentage move on average does the stock trade? So a general rule of thumb back of the envelope is a 1% move in the underlying, any underlying, is roughly a 16% volatility per day. So if an underlying moves 1%, that's a 16 vol. If it moves 2% a day, that's a 32 vol. If it moves 3%, it's 48 vol. So what that does is that's taking your percentage move and translating it into a volatility. So once you have sort of a relative sense of where volatility is, meaning you could be where the market's only doing that 1% move per day, right? You're in the very bottom end of, let's say, how that particular stock is trading, or it can be a 4 or 5% move per day where you have a much higher vol and you're in a much, what I would just say, an elevated state of volatility, sort of between how it normally is. So once you trade a stock, trade an index, trade anything, kind of has a range. So your spreads are going to reflect that. Like I think Dan mentioned a time spread. Those types of spreads are reflecting the fact that volatility is relatively low, where the relative movement is low, and you're looking for a reversion sort of back to a higher number at some point.
That's dynamite feedback. That's exactly the black and white kind of stuff I think that helps investors. So I appreciate that, Andrew. Dan, and I know the topic today is to spread or not to spread. We are going to get back there, but let's lay this foundation about volatility. What do you have to offer in that respect, Dan?
In terms of what would be, again, there's like as Andrew is demonstrated, it's such a big area, volatility. What would you, Joe, in terms of more volatility for the retail trader, or what zero in on what you'd like for this question, or just volatility?
I got you. Let's go to the bullish side of the ledger. Okay, so we're bullish on an underlying, and we want to do some type of option spread. What type of option spread would you consider for a bullish opinion, and how does volatility come into play in the decisions to which spread, to put on.
Okay, I got you. So first of all, I think just taking one step back, right? I think my sympathy with a lot of the people listening is, they're, especially the 50% of the folk who said I've never done spreads. The first dilemma is, you come out of, you wake up in the morning, you start swinging. Where do you start? And I think, first of all, I want to encourage people, have a plan. Where does all this stuff fit in? To me, I look at just as a basic overall plan, 3 parts of a portfolio. Your spec part, right, which is what Joe's question is here. Hey, you're bullish. You think it's going up, or you're bearish. You think it's going. So there's spec trades. That's one part of the portfolio, and maybe I allocate X amount of dollars to there. Then your income or range-bound type trading, which we'll talk about later. What are some spreads that benefit more range-bound? And I'll allocate some capital there. And then the third part of the portfolio I would call more neutral or long, which would be more covered rights, those type of strategies that are more neutral to bullish. So I think there has to be a context where you start. But what I've been doing, taking this, I'll just give you one example of, if I'm bullish, what would I do? And this combines a little bit of volatility discussion, would be, I'll call it a bullish butterfly or a time bomb butterfly, and I'll describe it in a second. But I know it's hard to believe in the United States, these stocks, but they actually went down for 2 or 3 days. And so after they went down 2 or 3 days, and again, they went down pretty quickly, what I was doing is thinking, okay, I think they'll bounce back a little bit. And because they move down fast, I think they'll come back relatively quick a little bit. So my duration was maybe 7 days or 9 days because of the speed. But then I thought, what could I do if I buy a call? That's going to cost me an arm and a leg. These are expensive stocks. So, okay, step one, I can buy a call. Oh, is there a cheaper way to do that? Well, what if I sell a call against the long call I'm buying? Well, that's called a vertical debit spread. Okay, that's still expensive in some of these stocks. Well, what if I sell a credit spread against the debit spread I'm buying? Well, that's kind of a quick way of saying I can end up in a cheaper way to take a shot to the upside, or a bullish shot, and that's called a bullish butterfly. And I'm kind of setting my short strike moderately above the price of the underlying. So if the underlying is 100, maybe I place my short strike at 105 or 110, where I think it could go up in that 1 week period. So what also happens is as the price goes up, I'm making money from the price move, and generally what happens in most cases is that the implied volatility or option volatility will decrease as we go up. And so a bullish butterfly will benefit from the price going up as well as the volatility going down. So that's just an example.
So, and I'll come to you, Andrew, but Dan, in that situation, where, what's the target price for the stock, and how much risk is there in that position?
I can give you real quick, just some guidelines, and then folk could kind of look at it and practice it maybe on paper. Lately, I've been doing about a 9-day duration. And so you say, well, where do I set the short strike? I set the short strike at about a 30 delta. And what that means is there's about a 60% probability it may come near or touch that strike in the next 9 days. So I don't want to put it too far away or too close. So that's where I put my short strike. And then I'll do my long strikes 10 points up and 10 points down from that. And so as the price goes up, and then here's the thing, as the price goes up over the next 3-4 days, that spread, maybe I pay $1, might go to $1.50 or $1.60. What I do, Joe, is I have a general guideline. If I'm going to be in a trade, these directional butterflies for, let's say, 9 days or 20 days, I'm looking only to stay in them about half the duration. And you say, why? Because if I'm wrong and it goes against me, as long as I don't stay in it, generally what I've noticed more than half the duration, I can get out with my clothes still on, if you know what I mean. I'm not I'm not, just destroyed there. And so I just kind of set some limits. I'll give it, if it's a 9-day trade, I'll give it 4 days. I'm usually looking for about 50% profit. And on a 9-day trade, I'll stay in it 4 days. And if after 4 days it hasn't gone my way, generally I'll get out. So I try to cut my losers as much as possible. So really, risk management involves around what can hurt you on the trade. What are the kinks in the trade? And so that's how I try to structure them. I hope that answered that.
Yeah, I think that's helpful. Andrew, you want to take one of these bullish position types and walk us through it?
A bullish position type, sure. So normally what I found is if you're buying options, upside volatility is usually a little bit lower. So we're going back to the concept about volatility again. And one of the easy ways, if you want to just get an idea of what's higher, what's low vol is, I think the SIBO, all kinds of, there are resources for like volatility levels, where vol is low, where vol is high. It's just like following a stock chart. So the CBOE, I believe, has one. I think the OIC might even have something on their website. Joe can correct me, just looking at some basic volatility charts. But as far as getting long, I'm looking at, and again, it kind of alluding to what Dan said, how fast do you expect the thing to go? Normally, if I buy options, I want to give everything just a little more time because I'm looking for, you can never be totally right on direction. So I like really, really, really low volatility, really cheap options that have a chance to become big options when I think a stock is going up. For me, buying just like a straight call spread, again, it's like a risk-reward thing. Most call spreads, let's say you have a $5 call spread, the most that call spread is going to be worth is about $2.50, and it's going to sort of stay there for quite a while until you get very close to expiration. So one thing about spread trading, and again, I think Dan was talking about this, is you can't ask too much out of the spread you're putting on. The only way you're going to get $5 out of a $5 call spread is if you wait all the way to expiration, nearly. Now, there's some reasons for that, but that's kind of how spreading works. So generally my attitude is I'm pretty bullish and the vol is low, volatility is relatively low. I want to own calls of some sort of medium duration, let's say 30 days or longer, something that has a little pop that I can manage. Most shorter-term trades for me are kind of spread trades. So like a bullish spread trade could be a bullish time spread using the weeklies where you're using that front contract to help pay the cost on the back contract. And that also gives you what I like to say one move out, meaning if you buy a time spread and you want to be long and you set it above the market, so anytime you trade a time spread or a calendar, you put the strikes where you want the stock to go. All right? So if I think the stock is going up, you want an upside calendar. So right now, I think Facebook is trading 173, something like that. And you want to get long, maybe you buy a 180 calendar, okay, a more aggressive trade because it's a little bit farther out of the money. But you put your spread out there. And by buying a calendar, you're letting time sort of pay for some of the premium that you're buying. So to me, like trying to get long, and what I would say is like a shorter term idea, either kind of like those sort of cheapy weekly calendars where you get a lot of potential bang for the dollar, or some sort of mid-duration low vol call that gives you, really good bang for your dollar. And then the same thing, anytime buying a call, you just have a stop routine. If you spend $6 on a call, you're not going to lose more than $1. And I think the easiest way to manage that type of trade is you have to have a really aggressive way to get yourself out. Kind of a little motto we have like an option pit. If you're going to lose small. You don't want to lose big, and have a way to get yourself out.
And that, I guess, I'm sure it gets back to your plan. Let me just, something you said, I'm not sure I heard you just right. You said you buy a $6 call, the most you can lose is $1. Is that part of
No, the most I want to
plan?
let myself lose is $1.
Okay,
right?
all right.
Most I want to let myself lose is $1. So you have an aggressive stop if you're wrong. So, I mean, one thing about trading options is you also have to be realistic, right, Joe? You're buying a call because you think the stock is going up, okay? It's not going up. How long and how much money do you want to spend for yourself to be right? What I have found trading and teaching options is your decision-making process is usually much better when you don't have an open losing position. When you've gotten out at a reasonable price and you can actually think what you want to do without looking at yourself losing money, I think people have an easier way to kind of make, at least evaluate, am I really right, or do I really want to be long? Do I really want this upside exposure in a particular position? So my advice is always have in whatever your routine is for closing, just make sure you have an aggressive way to get yourself out if things go wrong.
And Dan, I know both you guys are big in the discipline of having a plan. Dan Sharton, can you offer our listeners some sound advice how to become comfortable with your plan?
A plan in general or on a specific strategy? Just an overall plan?
Yes, overall.
Okay, so I'll tell you what, let's address 50% of the viewers, I believe Joe mentioned, didn't 50% of the viewers mention they've never done spreads? Is that correct?
That's right, exactly.
So let me speak to those 50% that I would consider probably newer to options, or at least they're, maybe they've done some long calls and puts, but you can start a plan whatever level you're at. So what I would do is that for the people who've never done a spread, a plan might be for the next 6 months, or next 3 months, their plan's going to be different than someone who's been trading for a while. For a lot of the students over shared and mentoring that we teach, I work off this concept of there's 3 parts of a portfolio. Your speculative, your income, and then your kind of long range income stuff that you're more bullish on, like covered rights. But if you're just beginning, what I would do is keep it simple. And so step 1 to get into spreads for people, for the 50% that haven't been doing this, I would imagine you know how to buy a call and a put, because it seemed like that was a pretty high number, right, Joe, for this?
Yeah, 81.
Many of the folks said 81. So let's start with what you have. So I would say for those folk, the speculative part might be a smaller and directional. That's probably what most are doing. I would do that and really monitor your results over a week. Kind of write down, how are you making your decisions? I don't frankly find too many retail traders that consistently make money buying calls and puts. Maybe this is an exception here today, but I don't think I found more than 5 in the last 15, 16 years I've been teaching that consistently make money buying calls and puts. It's a tough game picking direction. And I think getting duration a little bit helps, but in terms of a plan, what I would do is, for most of you over the next 3 months, start with, if you're buying calls, start out just a baby step. If you're buying a call, sell a call 1 or 2 strikes up from that call that you're buying. And that right alone, you're turning it into a call debit spread. So if you're bullish and you're used to buying calls, try to sell a call 5 or 10 points in the same expiration higher than the call you're buying. That's called a vertical spread, debit spread. So right away, you've sold a call against that expensive long call that you bought, and get used to that, right? And on the downside, you're going to sell a strike 5 to 10 points below the put you're buying. And I think that would at least move you, that would be a gradual step into spreading, because you're used to, 82% of you said you're used to buying a call and you're used to buying a put. So I think just over the next month or two, take some of what you've learned here today, and if you could just, when you're bullish, sell a call 5 or 10 points up, depending on the vehicle. And if you're bearish, sell a put 5 or 10 points down. That's a very natural transition from where you're at into spreads. That might be a first step for most of you that are watching.
Oh yeah, so just following on what Dan says, about a plan and trading spreads, trades have a beginning, a middle, and an end, right? You have an entry point, you have somewhere in the middle where, things are kind of happening, and then you have a way you're going to exit. And part of just a plan is knowing what your exit is. So one of the easier ways to understand spreading or putting it into your platform to understand how the spread works is, what's the most reasonable thing I could get out of it, right? Because you want to know what your spread is going to be worth over at some period of time. So because a spread can only be worth so much during the life of the option, what we'll call not the beginning, but sort of in the middle, so let's have a for instance. Let's say I put on a $10 spread where I buy the cheaper call and I sell the upside call. Your stock gets a move up, and all of a sudden your spread goes from, let's say, $1.50 to $3, $3.50. For you to make incrementally more money over a period of time, if the duration's very short on the spread, you can make money faster, meaning your dollars can accrue quicker. If your trade duration's a little longer, it's going to take you longer to make incrementally more dollars. So you have to ask yourself is, looking at the duration you have, is it worth staying in the trade? So some of the questions were, when do I roll it up? When do I roll it out? And my answer would be is, once you have a certain performance in the trade, and by holding on to it, you actually don't get a lot more money out of it over a period of time, that's a great time to get out of that position and look for another one that actually is going to generate dollars for the risk you take. Because remember, anytime you buy a spread or sell a spread, you're taking some kind of risk for that period of time. So anytime that I have dollars at risk in the market, especially with options, you always want that position to be able to perform over that period of time. So part of understanding spreading is getting an idea of how much you can get out of the spread, what is kind of a reasonable expectation for the spread, and then once you understand that, that will help you trip an exit point to look at another spread to buy. If you want performance, you need to be somewhat near the money. So my general rule is, when you look for spreads, if you're going to buy spreads, the shorter the time period of the spread, the closer to the money you want your long leg. Okay? If you're saying, I have kind of a longer term time frame out on this, maybe 6 months out, I think the stock is going to do something, then you actually can use a little bit longer term or a little bit more out of the money for your spread. It's going to cost you a lot less money from a dollar risk point of view, but you're also letting time kind of push the underlying up and out into a little bit more of a move. So when Dan was talking about time, it's really important because time changes the performance of any spread. A spread that you buy with let's say a 9-day duration is going to perform a lot different than a spread you buy of a 3-month duration if you pick the same strikes, right? That very near term is going to give you a very fast performance. So when you're looking at something and you want to buy something, you tend to want to be, when I think of spreading is, I buy where we are and I sell to where we're going. That's the easiest way. It's an easy rule for butterflies, just about anything you want to trade. You want to buy stuff near the money because that's where the gamma, and that's the ability of the option to move quickly. And then you want to sell the stuff out of the money because that's the stuff that takes longer to get moving. So you want to get buy stuff near the money, and then you sell stuff out of the money again. Duration is going to tell you how close to the money to be. The closer in time you are to expiration, you tend to want to be a little closer to the money on the long leg. And if you go farther out in time, you can afford to be a little bit, your near the money option or your long option can be a little bit farther away from the money.
Good guidance there, Andrew. Very good. You mentioned certain, in terms of rolling and certain performance of the spreads, and for either Dan or Andrew. I mean, you put on X spread. I mean, do you know when you put it on? And maybe I'll come to you first, Andrew, just to follow up. When you put on that spread, do you know what your exit point is? Either with, from the profit or, stop standpoint?
Yep. So there's two things. There's two ways to exit a trade. One is I've made as much money as I can make for the amount of time I've held the spread. So I know when I put on any spread that I'm going to hit about 90% of my profit that I know I can make for that amount of time. And if I'm anywhere close to there, I'll kill the trade. When I look at a butterfly, anytime the delta flips on the butterfly, and what I mean by that is I don't mean to talk fast, but when you buy a butterfly, it has an aim and a direction, right? So if I buy some kind of call butterfly where I buy one close to the money, sell two out of the money, and then buy one farther away, is that trade has a directional component. You want it to go to the short strikes. But once it gets to the short strikes, you lose the directional component. The trade actually gets kind of neutral. Once a trade is neutral, to me, all of the jazz of the underlying moving is kind of gone, and my profit potential is gone. Because I think it's hard for something an equity to sit in a place for like 1, 2, or 3 weeks. So I'll either use kind of a number, like a dollar number, I'm going to kill it, or I'm going to use the fact that since I really don't have any hard directional component anymore, that's another reason to kill the trade as well.
Okay. Dan, I mean, I know you have thoughts on when to get out of trades, good ones or bad ones. You want to offer them?
Yeah, and I think, again, just addressing a lot of the folk out there, seems like there's a lot of maybe beginning experience levels, but, one of the biggest problems I see with traders in general, whether they're beginning traders, advanced traders, professional traders, whatever it is, letting a trade lose more than you expected. And so to me, being successful as a retail or a professional option trader takes an incredible disciplined plan. And so just giving people just something to maybe keep in their back pocket on every trade that we teach, whether it be a bull call spread, a bear put spread, a butterfly, a calendar, we have a simple 4-step risk management plan on every trade that should guide you on this. And so step 1 would be, how do I set the trade up? If it's a bull call spread, what strike do I buy? What strike do I sell? What duration? So your setup is the logistics. When are you going to put the trade on? The duration, the strikes, that type of thing. And that can be repeatable. Step 2 is, what's my profit target and max loss, right? And that has to be, and that's really important. What is based on the spread, maybe a directional butterfly trade, I'm looking to make 50% on what I pay. Maybe on an iron condor, I'm looking to make 8%. It just doesn't have the profit potential. But here's the key. I think the most important thing when you're creating an exit or a plan for a trade is, I'll call this at step 2, you have a profit target, but you have a max loss, right? You have a max loss. And that's not a negotiable number. When I hit my number, I'm out, right? I live to trade another day. And if people could keep their losses, in my opinion, Joe, close to their average wins, they won't have any problem. So step 1, set up. Step 2, on every trade before you trade, what's your profit target? What's your max loss? And this depends on the trade. And then step 3, as you get more advanced with this stuff, would be when you adjust, and step 4, how you adjust. So And that's what keeps the emotions out of trading. I mean, people that freak out when they're trading or lose their discipline or something like that are generally what I notice is people who don't have a plan. So if you kind of stick by that, at least as a rough template, a 4-step risk management plan on every trade, then you're not in the kind of casino business. You're actually well thought out.
Outstanding. Andrew, anything you want to offer in terms of your approach to initiating a trade? Because then I want to go back to something.
Okay. I don't know if I have a whole lot more to add today. I mean, there's a lot of, I have a massive checklist of things before I go through before initiating any trade, which I don't think we can cover in this. But yeah,
fair enough.
You have to know you have to know where you're going to get out before you get in. And that level has to be so enticing for you that will generate an exit or generate an entry. So if you go into a trade where the most you're going to make is 25 cents, you got to think kind of hard on, does this look really like a good idea? Is this a good use of my time and my money? And generally, trades that have decent exits, if you're correct, are going to be better trades to begin with because you've actually thought out the whole process from, like I said, the story, beginning, middle, end.
Okay. We got 10 minutes, guys, so let's see. One thing, and I know this is about to spread or not to spread, and it certainly sounds like there's a strong consensus to spread. Dan, let me go back to number one with you, the setup. To me, the challenge and fun in the option space is what strike, what month. So Dan first and then Andrew, can you offer any detail as to, how to choose that setup? What strike, what month or what duration? Dan?
Absolutely. Joe, do you want me to pick a strategy or you? So for every strategy,
go for it.
Okay. I can give so just pick a strategy and go for it. Okay. So, okay, let me think what would be, okay, let's just take a basic, what's today? Today's Thursday. So on Thursdays, let's just say I'm doing a calendar trade. I teach to do things repetitively. I think we're a distracted society. We're a distracted country, right? And I think what I like to do, even for myself, is put on, for the most part, obviously would be aware of what's going on in the market, but let's say every Thursday, I will put on a 15-day butterfly, right? So what would be my setup? So every Thursday, I've done this probably for the last 2 years. In most of those 2 years, we've been in a lower volatility environment. So what I will do is if I'm doing a 15-day butterfly for weekly income. So every Thursday, I will put on a 15-day butterfly sometime. Usually I'll put it on probably about 1 o'clock in the afternoon. 50% of the time, I get it off by Friday, the next day. And I'd say 80% of the time I'm out of it by Monday. So the setup is this. I look at a duration that expires 2 weeks from the upcoming Friday. So today is Thursday. If I want a 15-day butterfly, I'm going to go 2 weeks from tomorrow. 2 weeks from tomorrow. So that's my setup. That's the duration I use. Every Thursday I put on that duration. What strikes do I sell? I do it in the calls. You can do it in the puts or you can do it on different types, but I'll usually do it in the calls. And again, this may be over some people's heads, but I'm just giving you an example of a setup. And I do the same setup every week, generally, unless the volatilities change a lot. But I'll sell an at-the-money call, sell two, sell an at-the-money call in a 15-day duration, and then I'll go 30 points down. So I'm going in the expiration 2 weeks from tomorrow, and then I'm going at, let's just say we're at close to 28.55. I'll sell two 28.55 calls, and I will buy one 28.25 call, 30 points down, and then I'll buy one, go 30 points up from my short strike. I sold the 28.55s. I'll buy the 28.85s. So buying one, selling two, buying one, and both calls are 30 points away from the short strike. Then I will look at the position deltas of the trade, and my goal is to get those close to zero. So right now, if I set up a butterfly where my lower strike long call and upper strike long call are 30 points from the short strike, I'll be two short deltas in for what I'd like to do. I want to get the deltas on a short-term trade, a 7 to 15-day trade, close to zero. So then what I'll do is the setup to get my deltas as close to zero as I can, relatively. I'll take my upper strike long call and come down 5 points. So in this example, if I'm selling two 28.55 calls and buying one 28.85, I'll come down and buy one 28.80. What will that do? It'll cut my position deltas to zero. So that's just a little bit on the setup. I talked about what duration I'm doing every Thursday. Generally for a 15-day butterfly, what's my strikes I'm doing. Sometimes that'll change, but this is generally what I do. Sometimes it'll change based on volatilities, but this is what I do, and it's that repetition. Every Thursday, I will do it. Now, I'm looking at the speed of the market, but unless we have a 1% move in the underlying index, when I go in the morning, it's this repetition for the setup. Repetition, 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 and that's how people become a good craftsman. And so we're putting on this 15-day butterfly every week for the next 52 weeks. That's basically the plan. Unless volatility very rarely, but it can get very low that I may switch to something else. But that's the plan, that's the setup, and that's the road to becoming a good craftsman. More or less, the way we teach is repeatable trades you're doing over and over and over and over. And then by looking at the price of the underlying, by looking at the speed of the underlying in VIX, we'll make little tweaks. But I don't every week say, okay, what are we going to trade? Because, with most retail people out there, like most of the people watching this broadcast, if you said, okay, volatilities are this or volatilities are that, trade this or trade that, they'd look at you like you're a drunken sailor. In other words, they don't know how to do all these things. And I think you start with one thing. Like I said, today, for most of the people buying calls and puts, sell a call at a higher strike than the one you're buying. If you're bullish, sell a put at a lower strike if you're bearish, and then kind of go from there in terms of maybe a calendar. But I would say, whether you look at, you've heard these terms today, butterfly, calendar, iron condor, trades that we use a lot for weekly and monthly income. I would take one and try to practice it on a weekly basis. It's that methodical, that's how you're going to get good at it. If you're switching stuff every week, it becomes jack of all trades, master of none. And basically what we're going to try to teach them is, how do you navigate through a butterfly or an iron condor or a calendar in different weather conditions when the volatility is high or low, and it's a learning process. So anyways, those are some thoughts on volatility. And but the biggest thing for a lot of these newer traders that are listening, Joe, is continue the learning, but don't try to become a theoretical master, right? You need paper trading. You need some small live trades, but don't try to stick with one thing and get a little better at it.
And with that, I just want to thank both you guys. Andrew, Dan, thanks for offering your wisdom to our listeners today. A lot of black and white here, and I think that's a big takeaway for folks. Rather than, as you said, Dan, you can't just live in the theoretical world. It's got to be, the real world. So thanks for offering your insights. It's Dan Sherton of Sherton Mentoring and Andrew Giovanuzzi of the Options Pit. Check those guys out.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.